Kimberly-Clark reaching a deal to acquire Kenvue for more than $40 billion. David Faber joins us with the details, although I guess, David, we've been watching the way Kimberly-Clark shares have been trading in reaction to this news. There is an equity component of this proposed transaction, so maybe that brings it below the $40 billion number. But what can you tell us about some of the ins and outs here?
Yeah, sure, Mike. You know, it's something I've been tracking. We've been discussing for quite some time on Squawk on the Street, given Kenvue's issues, certainly in terms of its organization. Got rid of its CEO this summer, for example, has an interim CEO. Just, you know, really since its spinoff from J&J some time back, had never been able to really get it together, despite what is an incredible portfolio of brands that includes, of course, Tylenol, which we'll get to in a moment, Listerine, and, you know, many of those other Johnson & Johnson brands that people know well from in the consumer aisles. Kimberly-Clark's been talking to them since June, so it has been going on for a while, is my understanding. And it does bring together an enormous group of brands, of course, that conceivably will rival the likes of P&G. At least that's what the intent is here. And, of course, the hope is that at some point you start to get a multiple in the stock market that comes close to that of P&G. Not happening today and probably won't happen for some period of time. But as I said, Kenvue is a company that's been in sort of a state of transformation or a need for it. Now it's going to be done within the merger context. And the fact that they at least identify as much as $2.1 billion in cost synergies gives them some room here to figure things out, both at Kenvue and then overall for Kimberly-Clark as it brings the company in before the close of the deal, which is not expected until next year, close of the second half of next year. As I mentioned, $2.1 billion in revenue run rate synergies. I'm sorry, not revenue, mostly cost synergies, $1.9 billion. There are revenue synergies as well, and then they see it being accretive over time. Mike, you know, you mentioned the consideration here, and it is largely stock. It's $3.50 a share in cash. The rest is in stock. It is, as you said, it's a ratio, 0.14625. And given that decline in Kimberly-Clark shares, of course, the overall value of the deal is going to be significantly impacted. That said, at a 50% premium, you're still going to see Kenvue up a lot. But the hope is here, certainly, of both Kenvue and agreeing to the deal and Kimberly-Clark as well, is that you're going to have 46% of the shares owned by Kenvue shareholders now. They're going to get the opportunity to participate in significant upside over time as they take in these synergies, as they reorganize the Kenvue business to a certain extent. And one day you may actually reach that promised land of getting a multiple closer to that of P&G or Colgate. Kimberly-Clark's been interested in acquiring this company for a long time, guys. In fact, they tried to propose a reverse Morris Trust deal to take it out of J&J before it got spun off. They weren't there. They weren't successful then. They were this time, and getting it at a price that is significantly depressed in part because of that linkage that is claimed by this administration between Tylenol and autism, which significantly impacted the shares, and my understanding as well is took down what was the original cash portion of the deal, a commensurate amount to account for that decline in the stock. We'll have more in the 9 o'clock hour. Andrew, over to you.
Hey,
actually,
David, my question to you, though, is we've been looking at just the way the stock is moving. This is not a classic arbitrage play in terms of just how much damage seems to be happening to Kimberly-Clark's shares. At the same time, obviously, Kenvue's up.
No, I mean, listen, Andrew, there's a litigation risk here, right? That's got to be what right. In part what is, and they believe that given the $2.1 billion in synergies, the fact that they are buying it at a price while at a 50% premium is still well below the multiples we've typically seen in this group. It's around 14.5 times versus a median usually of around 18 times. They believe that more than makes up for any risk they may be taking on. And they clearly, obviously, do not believe it is significant litigation risk. But that's got to be one of the reasons, Andrew. We all remember Monsanto and Bayer, for example, and the headaches that... Not headaches, the incredible, disappearance of value as a result of the litigation that took place there. And so that is something that's got to be in people's minds, in addition to risk arbs who do set it up by shorting the shares of the acquirer.